Okay, maybe before I jump, direct into the topic, I thought it would be good to share a little bit about myself so that it's not to promote myself, but I'm not a regular speaker, so you may not know. Now, and why am I here, obviously? So, I think I was here in the same forum in 2009, also talking about ETFs. I think it was quite interesting because in 2009 was a very memorable year for me. For two things, which I'm very thankful for. One is obviously my firstborn, little girl. She was born also round about March, early March. How can I get it wrong? Early Feb. My wife is not here. Now the second baby that came was a little bit later, and my wife wasn't fully aware of that. So it was like, okay, hold your thought. Now the second baby was actually the launch of an STI ETF, which I worked on. All right. So it took me 1.5 years to work on that. So those were the two babies that were delivered in that year. Very memorable for me to mark the start of that journey. Both are growing quite well, quite nicely, coming along. It's been 6 years on, and I'm very happy to come back here again 6 years down the road, still talking about ETFs, and hopefully more people will, recognize both the pros and cons and so on, and the values that an ETF may bring. Now, you know a little bit about me, perhaps just a quick exercise. If you can help me know a little bit more about you, all right? How many of you, if you can just through a raise of your hands, how many of you have bought an ETF? Just so that I know. Okay, it's roughly less than 5% in this room. Sorry, the other side, I probably can't see you in the other room, but 5%. Now, second question, and that will be the last one before I move in. Anybody who on a scale of 1 to 10 says, I really have no clue what an ETF is. Could you just help me? Roughly about the same. So I think we have 5% at both ends, and then roughly about 90% in between. I heard of it, I know a little bit about it, but not enough. Let's hope to address that. Now, you may find that sometimes at certain section of the topic as we go through, you already know, but bear with me because as you see, it's quite wide, the spectrum. Some have bought quite a lot, have not, and there's a big gap in between. All right, that helps me to sort of pitch it. Now, we start off with, obviously, the simple stuff. Start with a definition to anchor the topic, and then we move on from there. ETF, definition of an ETF. You can read. It's an open-ended fund, a collective investment scheme, listed and traded on exchange. An ETF typically aims to track the performance of an underlying index. All right? Quite important to remember these definitions. We'll come back to it, and I'll explain each section of this as we walk through the entire presentation. Okay? Now, obviously the question is then, what's an index? Why does it bother us to track an index, right? Now, an index is primarily there are companies out there that compute an index, all right? We just call them just think of it as an index calculator, an index company. That's generically how we refer to these guys. Your MSCI, your FTSE, those are the guys that specializes in this, Dow Jones as well. Now what they do, they look at stocks that are already listed on the exchange, all right? They have certain predefined rules. For instance, market cap, which means how big the company is. Free float, that means the availability to the investor public. So through a fixed formula, they will calculate and come to a weight. How much weight to assign to each company. And then they choose. They will probably sit down, have a discussion and say, do I want to pick the top 10, the top 30, the top 50, or the top 300 stocks? So that it becomes representative of the financial market, which is by extension an indicator of how the overall economy is doing. All right? So think of it this way. The index is purely a calculator. All right? They calculate based on a predefined set of formulas on those factors I've indicated to show you a barometer of how the financial market is doing, and by extension, how the economy is doing. That's important to understand because when you buy an ETF, it tracks an index. What's the driver at the end of the day? How the economy is doing and how the financial market is doing. All right, so that's how it links all these things up. All right. Now, examples are obviously the ones that are very familiar with all of us: STI index, and then you have S&P 500 on the US. All right. So now you know what is the definition and what is an index. and how they calculate an index, and more importantly, the linkage between an index to the real world economy which you and I live every day. Okay, why are ETF increasingly popular? It's taken off in a much bigger fashion in terms of the adoption rate elsewhere in the world for a couple of reasons. The convenience, which we have listed here. Obviously, there's no need to do individual company analysis. Coming back to the point about index, remember, it looks at the overall basket of stocks that are listed and then the economy, all right? So you're not beholden to the fate of an individual company. That's the other way of putting it. The management fees are very low for an ETF. The reason is because, okay, I'll hold that off, but just do know that the annual management fee is low. I have another slide coming on which will explain that in greater detail. And it allows investors to have a very quick and easy access to a variety of asset classes, right? Because it is listed, you can buy in and out during the course of the trading hours, 8 hours a day, anytime. Try that for a unit trust. They'll say, please come back tomorrow, or so on and so forth. End of day, submit your forms, but you can only do it, we get an evaluation the day after, and then we'll let you know how much you're getting. So that's the hope. That's kind of like the process for a non-listed unit trust. There are some advantages here, all right? Because timeliness in a financial market is also quite important. You may want to get out of something and get out of an ETF and buy a stock that you like, or vice versa. All right. So the flexibility comes in. Indexing. Let's talk about index. Back to the story of index again. Now remember, I was saying you're not beholden to the fate of a single company because the index typically computes a group of companies. All right. So what happens is, just to give you an example, I think it was the Dow Jones. When it first started, there was 120 companies. No, 12 companies. Sorry, when it first started, can't remember which year, but easily 120 years ago. The index still continues. All right. Currently, it's still in use, and of the original 12 companies, only one is still in the index. The rest have fallen away. Probably either it lost its relevance, becomes a lot smaller, bankrupt, or so on and so forth. So the index has got a survival bias because the index company, the calculator, all right, once those companies, in terms of some of the attributes like market cap, so on and so forth, it becomes less relevant or it fails to meet the criteria, they remove it. They replace it with a new company, and the index goes on. Now, from that perspective, an index can go on for a lot longer than an individual company. So if you're afraid of making a mistake by buying a particular company and you really want to sleep on it and not worry about it for the next 20, 30 years, this could be an alternative, right? Just so that you understand, that part of the dynamics. But having said that, index is not only confined to equities and companies, all right? There are also indices on bonds, on asset commodities and asset class, so on and so forth. So it's a wide range. But my starting point in terms of, for this particular forum, most likely I'm going to make quite a fair bit of reference to the STI ETF, the STI index, because it's familiar. Sing dollar based, your asset liability is matched, and of course because I launched one of them. Right. So the other part about the indexing story is obviously the performance. All right. I'm thinking whether I should jump into that now. I think I should. Okay. Now, for indexing, what it does is, if that's the case, you form a fund, an ETF, that will track an index. Right. Do you need a star fund manager now? You don't. Basically, I just follow what the index calculator, the index company tells me. Right. These are the ratios that you should buy. Right. So me being a fund manager, when I launched the SI ETF, was a simple job. I don't need to exercise a lot of, sorry, let's play it the other way. That didn't come out right. My workload is significantly reduced. To buy into 30 stocks, I need to know the balance sheet, the corporate governance, is the management a crook, what is the landscape, competitive landscape, how is it going to growth profile. But with the SI ETF, every day I just download what is the composition, at what weight. I go back to the funds, buy, sell, buy, sell, buy, sell, boom, boom, move, right? So you should pay me less for the effort, all right? Just because that's what I'm doing. I'm merely replicating that. Very simple. So by extension of that, the fees involved and the effort involved when you do passive investing, or what we call index investing, is significantly lower, right? Over time, this will have quite a significant impact on your returns, right? So bear that in mind. Now, talking about returns, let's use this example because, as I mentioned, it's widely understood and so on and so forth. So I'll just use this. The STI index, most people will classify and say Sing market is not as interesting. The US, the Europe, volatility is there. I can make money faster, so on. But if you look at the long-term sort of return profile, over 8 years, right? The long-term average over the course of time was about 8.7%, which means that you're able to compound whatever investment you have over a course of 8 years and double it. Despite that, I think a lot of money is still in the investable CPF savings, all right? Only 12% of the 74 billion are used in that sense, all right? So, and we also have a table for you just to show a comparison over a longer term horizon. Not as exciting in terms of the movements and all that, but from a return perspective, if you and I are looking for returns, then, it's interesting to have that fact as well. Now, we've talked about index. We have shown you over a longer term how the index performance is for the STI index. So, for an ETF, how should the returns look like? The blue bar is the index return, and for the lighter color bar is the ETF. It should track very closely. But as you can see, from time to time, there is some variation. There is some slippage, right? What causes the slippage? You still have to pay fees because I'm the guy behind who does that rebalancing for you every day. So you still have to pay some fees. Therefore, from whatever the index gives you, it's still a little bit lower. You still have to pay a fund administrator. You still have to pay a trustee to look at it. The trustee helps to look after your interest of the unit holders. So those are the fees that comes in. And the other component is obviously the index calculators, the index companies. They compute it on a desktop exercise. All right, this is at the end of the day, this is the closing price. Based on my formula, I compute it as such. But for me, I face the reality of the market when I go buy the stocks. I want to buy an SIA, ST Engineering. I face brokerage charges. I face the movements intraday, demand and supply, because on an intraday basis, there will be differences, all right? So for instance, when they computed the index, ST Engineering, for example, is at $4, but when I actually move out and buy it, I may be paying a little bit more, $4.05, for example. That accounts for the slippage. So that's the difference. But over a longer term, it should track very closely. If the guy does a lousy job at it, you will see the variance is significant, and therefore it will be a cause for concern for you and says, gee, I want to look for another ETF that tracks it, better. All right, because of those slippages. Now that's what's causing the difference in the two charts. Okay, some of the factors. So I've also talked about a few things, primarily focusing on the index so that you know the link to the real world. The ETF returns should be very, very close to the index return. There will be slippages. You now do understand what causes the slippages, and you can question. And when you buy an ETF, you can start questioning them if it varies, and that's an important point to see how good they are. The ETF manager. Now, who uses ETF? Right, globally, I think the institutions are the ones leading the charge. They have been very, they have all the resources. They have teams of research guys doing the, company research, so on and so forth, the resource to go behind it. But they're still using ETF in certain ways. So the question is then, with a whole bunch of resources versus an individual retail guy, why are they still using ETFs, right? So, and if you understand that, then maybe it's got some implication for you as well. Now, the guys that use pension funds, insurance, bonds, investment advisors, and even fund managers themselves. So those guys who are the active fund managers, from time to time, they will use this as well, right? We have done that before. Now, why do they want to use it? Because for the benefits that I've indicated earlier on, it is very cheap, low cost, relative speaking. The ease of accessing this, because it is listed. They like listed stuff because they are so used to buying stocks that are listed. They enjoy the convenience, and this is listed as well, despite the fact that it is more like a fund. It is actually constituted as a fund, as a unit trust. It's a CIS. So the liquidity management, asset class exposure, and then the efficiency when it comes to moving in and out. Those are some of the reasons why they want to use it. And despite the fact that they have all these resources, they are still using it. The retail investors, guys that are using it, their income looking at buying, probably a diversified basket, seeking access. That's a very important point, seeking access into global markets. Because previously, can you imagine if you want to buy, just pick one in Europe, one in US, and Hong Kong, China, Indonesia, you have to individually, for each one, look into the companies that is representative of that particular country in terms of the economy, but yet at the same time be subjected to sector analysis and individual company analysis, right? A lot more work. But now, if you want to have a global portfolio, it is possible. You just buy one ETF. You know it is through a basket of companies. That will be somewhat, it's not a direct one-to-one, obviously, but the link is there, as you can see from the index of all the top companies listed on the exchange, and then into the underlying economy, strength of the economy. So have that in mind. So it opens up quite a big window for you as an investor. Next part is obviously we should then compare, right? Stocks, the unit trust, with the ETF as well. Having gone so much into the aspect of an ETF, we should compare and see where the plus and minuses are. Now, let's start with stocks. I think most of you would have bought a stocks. If I ask for a raise of hand, which I won't, probably a higher proportion now, maybe 80-90%, I'm guessing. You can buy and sell during the 8 hours, trading hours, all right? Intraday, you have liquidity, which means you can actually transact, buy and sell, and there is a price to reflect every minute of the day, right? Now, but for single stocks, obviously, it is very precise. You buy specifically into one stock, and you are then held to the returns, up and down volatility of the particular stock, right? So you understand that. On the side of the unit trust, which a lot of times is sold by the banks, it is a diversified portfolio. You have a fund manager behind it helping you to choose what are the right stocks to buy that they think will outperform the index or whatever benchmark they have, right? That will reduce the risk to a single stock. That's a plus for you if you're not looking for, or if you don't have a stomach for that of the volatility and returns of a single stock. Active management, because you need a fund manager, you pay more because these guys have to do a lot of work. Fair. Additional cost because those, as I mentioned right at the onset, are sold by the banks. The guy who is standing out there with a nice big smile on the face, who tells you, sir, would you like to consider this because so on and so forth, you need to pay him as well. This all comes from somewhere, not free. Now, with that, an ETF removes some of this, all right? It is, by most accounts, if I were to sort of draw an analogy, it is more a unit trust that is listed. But obviously, we don't call it a unit trust, we call it an ETF, right? Because it still holds a basket of stocks, right? So you have the diversification there. Because as I mentioned to you, when I launched it, I didn't have to do a lot of work. You pay me less, so I'm still very poor. Additional cost in terms of sales charge. Because it is listed, the margins tend to be much lower. The banks don't have somebody standing out at the front door greeting you and say, would you buy an ETF? Typically, no. But I'm quite happy over the course of the 6 years, things have changed a little bit. They introduced the regular savings plan, which is a low cost for them to allow you to provide an access for you through the banks to buy into an ETF. Still good. Still a good development. All right? So, an ETF removes some of these items which eats into the return. All right? And gives you what I would say the best of both worlds. And think of it, if you can think of it, the ETF is like a Swiss Army knife. You can use it in a lot of applications, a lot of ways which you can use. I will talk to you about that later. But obviously, it lacks the precision. It lacks the precision because if you buy an individual stock, it's very precise. If you use a purpose-built screwdriver to unscrew, a screw that has been bought on, it will be a lot more effective. But the Swiss Army knife gets the job done 70 to 80% of that, but probably not with the full leverage and not with the full ease. And what you give up in this instance is probably the returns profile of an individual stock. Having said that, because an individual stock can rise much faster, tends to rise, I mean, if they're rising, will rise much faster because you're only solely dependent on the rise of one stock. Whereas in the index, which the ETF buys into, again, is a basket of 30 stocks. I keep coming back to that point because I have to stress that so that you guys understand it. And therefore, when you say, hey, buy an ETF, it's not moving as fast as a stock. Why? You know why, all right? That's very important. So it combines both the attributes of a unit trust and a stock, put it into, package it together in that sense, and it brings to you what we call ETF. Now that explains a lot of the reasons why the institutions are using it. And I'll tell you about the application on how they use it, which you may find useful in your day-to-day investing as well. Now, the point about cost, because I talked about the index return, and then I show you the dark blue chart, and then after that there was a slippage of a lighter color chart. That's a slippage. All those eat into your returns. Now, just to give an example, over the course of 10 years, for a $10,000, because of, etc., all the costs involved, right, in if you buy, let's say, we compare the index, a no sales charge and management fee, right, which is the ETF, and then we compare one unit trust A, which has sales commission of 2% and management fee of 0.5%, and unit trust 2, which has got a sales commission of 3%, even higher, and a management fee of 1%, right, compared to the index return. So over a course of 10 years, for $10,000, considerable amount of money. And if you are looking at a longer horizon, because of the effect of compounding, obviously, a little bit less. Actually, a lot less. All right. So, take a pause for a moment. We have, is that an ice cream bell, or is that a bell for me to end soon? Oh, sorry. Okay, probably a bell for me to... I'll move a little quicker, all right? But I thought it's very important for me to spend a lot of emphasis on the first part of the presentation to walk that through with you so that you understand, all right? To conclude the first part of it, the very important thing to understand is you can think of an ETF much like a unit trust, all right? It is not in and by itself although we loosely use the term as a product, all right? You shouldn't think of it that way. Because if the ETF in that structure, in that vehicle, chooses to invest in a commodity, a fixed income, or theoretically in the weather tomorrow, the return, if it rains, I pay you $10. If it doesn't rain, it doesn't pay you $10. If there's an index company that comes and so use that, an ETF can deliver that, theoretically, all right? So that's a very important point I want to bring across, because from time to time when we go to ETF conferences and people ask, hey, the returns of an equity ETF and a bonds ETF, is it going to be widely different? The returns is driven by what it chooses to invest in the underlying. So the returns profile do not change for an equity versus a fixed income. So to ask that question, you may have missed some of the points. So, which is why I keep stressing, I was struggling, pulling my hair and says how to put that point across. I hope I did, so that you won't repeat the same question and says, an equity ETF versus a bond ETF. It is no different, all right? The returns from equity and bonds, even if it is wrapped in an ETF sort of structure and format that comes to you at the end of the day. But it makes it a lot more efficient in that process. Okay. I'll move a little bit faster in this because the base we have covered, hopefully you have understood. We will cover any questions you have later on. Now, if you do choose to take the next step and try an ETF, having considered both the pros and cons of it, there are disadvantages because, like I say, the precision is less. The returns profile of a group of companies is going to be quite different from one company. Again, I'm stressing, I use equity, all right, because it's more easily understood. Now, what is available on SGX? We have 65 equity-based ETF from a country perspective. These are all here. I'm not going to go through every one of them. Like I mentioned, there is also the ones that are commodity. We have 6 money market ETFs, also 6, and 12 fixed income ETFs. All right, so those are the different flavors, but all comes under the wrapper, the structure of an ETF. That's available. Now, how would you use it? A core satellite approach has been quite frequently cited. It is useful because, for instance, this is my personal trade. I'm not pushing it. When I launched the ETF in '09, obviously a big part of it has also to go into that space. And what I did was I held that. At that time when we launched it, the index level as 1,006, it was terrifying because we just came off the crisis. Right? Nobody wanted to invest in my ETF. It was very tough raising money. So it was at 1,006, everybody was shunting it. So we put some money into it. That remains a core part. I still hold it after 6 years, and I do intend to hold it longer. But in between, does it mean that I put all my money there? No. From time to time, I can't get off the strict about, I used to do research and also portfolio management. So when I see a good company, I smell a good company, I still enjoy that. All right? So I go into other stocks. From time to time, I have a call, I cap it there, but then I still buy and trade on a shorter term basis the other stuff. That's one way, all right? So some people would have depending on your age, your investment profile, your risk, reward, appetite, you may want to put, for instance, in my case, I'll be quite happy, 40, 50% inside a core, and then I still have, because my appetite, I've been in the industry a fair amount of time, I have a much better appetite for the other stuff, right? So which is where I still continue to trade in that manner. So that's one example. The other example, obviously, you want to build a global portfolio now, right? So, Sing being a home base, I have a lot of Sing dollar liability. Okay, the ice cream bell rang again. I have a lot of Sing dollar liability. I want to match it. Therefore, my core portfolio is largely in Sing. But then the next thing is, with the volatility in the global economy, the US, the Japan, I think a speaker will touch on that later on. Vasu will have a good time talking about because of the volatility. I want to participate in that as well, all right? And sometimes it's because it's policy changes, because in Hong Kong and China, because of the Shanghai, Hong Kong Connects, there was a lot of movement there. So the greed in me prevailed, and I figured that again, I'm not saying this is for everybody, I'm just trying to give you an example of how I use it. Okay, please think of it in the right context. So at that point, in this particular instance, let me elaborate a little bit more. All right, before the ice cream truck come and run me down. Obviously, if you see the Hong Kong Shanghai Connects, what has happened to the indices, HSCEI, for example, and the Shanghai Comp as well. It was moving like, even at the individual stock level, they're moving like, crazy prices. I'm not suggesting this is for everyone, and I'm not highlighting that you should. Please bear that in mind. But I'm just trying to highlight to you the time sensitivity of it. They were moving every day like, 3 to 5%, and some even higher. Right, even higher. So I figured out, I used to look into China, and I'm very familiar in that, which is why I have certain comfort level myself, based on my risk return profile. I keep stressing, right? I have MAS here. So I need to be very clear. So this again is my personal profile, but I knew that time was of essence in that scenario. And the only way is, if I want to buy into individual stock, I've got to go back, look into whether, even though I know the company, it's been a few years, I still need to look into the balance sheet. Has the management changed? And what is the competitive landscape? I felt that I didn't have enough time because I would spend at least a couple of days to a week just to refresh myself, right? Then I decided to get some exposure, a small amount, through an ETF which tracks a broad basket of stocks over there. Now, mentally, that does a lot of things for me, all right? Mentally, because I know that I have some exposure already, and therefore I'm not totally missing out. That's how I deal with my greed. I'm not totally missing out. Then it relieves me, and I start to look into the individual stock and says, okay, what were some of my favorite stocks that I used to look into? Let me get back. It relieves me of that time pressure. It's like, I just don't want to make a mistake and then, go back and regret because I bought it on impulse or very quickly based on what I knew 6 years ago or 3 years ago, for example. So that's how I use it. Just citing 2 examples of how that's used. Okay, I'm going to skip maybe the rest. But this one, bear with me, one last one. An ETF has evolved over time as well. What I've been talking about is probably the Gen 1, right? First generation of ETFs where, very simple, they use whatever monies that they collected from the individual investors from yourself, should you buy it, put it into a fund, they use all the cash and pump it and buy the stocks, each and every one of the component in those weights, right, and give it to you. That's called a cash base because they use all the cash and then put it inside there. Replication and full replication, meaning if there's 30 stocks, they buy all 30. A variant of that is some of the fund managers started to say, in some cases it's not worthwhile if you track an index with 500 stocks. Imagine buying, selling 500 stocks. It's going to be so tough. So they figure out, they do correlation and so on, a lot of analysis. No, I'm not belittling their effort there. There is a need. There is a need. They started from there, obviously. So they say, instead of buying the full 500, I'm going to do perhaps 300, whatever the number may be. That's called partial, replication, a sampling replication. All right. Now the third one, synthetic. All right. Synthetic is they may not use all the cash that they received from you, from the unit holders, to buy all that 30 stocks, 500 stocks. They don't. Right? They don't. What do they do with it? That's the next question. Hypothetically, if the fund is $100 million, I take the $100 million, I go to somebody and say, okay, now, again, it arises because there was a need. All right? And then, as it grows, people use it for other applications. But I start from base one. Accessing China market. Assessing Vietnam, where there is currency control and restrictions of money flowing in, right? That's a very useful example because I was trying to raise one as well. I can't assess that, but yet I know investors want exposure into China, okay? So what am I going to do? I'm going to go and look for somebody that says, okay, can you promise me the returns of the China index, for instance, the A50, okay? I'm going to give you $100 million, maybe $95 million, for example, right? I give you. On a handshake and a whole stack of paper with all the covenants, with all good intention, all right? Not bad intentions, because I want to guard my 95 million with these guys. But at the end of every single day, every single month, you give me the returns that is the same as that of the A50 index, all right? Now, it introduces an additional layer over there. This guy whom I had a handshake with, and with a whole stack of legal papers and covenants, and clauses to protect my money. Therefore, that arises, if he goes bankrupt, I have a bit of a problem here, right? I may not get my 95 million back. So that's where some of the risk, without going into the jargons and all that, essentially that's what's happening on the synthetics. So people are always saying, be very careful about synthetics. Please do understand, that's the route of it, and probably in terms of how it arises is by providing a need at that point in time of access, and then it proliferated. So synthetics is not necessarily a bad thing, but there's a place and time for it, and as long as you understand the full chain underlying, I think it's good. If you find that should you choose next time there's another emerging economy that you think you want to access, and it's not easy because of currency controls, money flows controls, so on and so forth. Synthetic, right? You don't need to shun it, but you need to find out who is the guy I have a handshake with, some of the covenants. Obviously, a lot of things are involved. I'm just touching the broad concepts of it, right? Because there are many variants thereafter by how they control in terms of the counterparty risk over here. Because in some of the ETFs, it says, out of the 95 million, you cannot only hand it over to one party. You need to split it up with, let's say, 10 parties. Again, that helps to mitigate. So you need to look into that. All right. So the main idea is, I cover the main idea, but you then have to do some homework if you want to go into that. All right. ETF for everyone, obviously, no. These are all the considerations that you need to have. The returns I mentioned to you, will fluctuate. The risk associated with the use of derivatives, because I'm not labeling derivatives as bad, but you just need to understand that chain. Just remember that on the synthetic portion of it, all right? They're not principal guaranteed, obviously, because it is like a stock from that perspective, right? So what are the things you need to watch out for? Market risk, obviously, it goes up, it goes down. Tracking error, I briefly mentioned the blue chart versus the green light color chart. That's where the difference is. Foreign exchange, if you buy into a US denominated ETF, there's risk on the currency. Liquidity risk, when you want to buy and sell the ETF on the exchange, just like a stock. If you buy an illiquid stock, you suffer the same stuff. All right? You may not be able to buy and sell. Simple. Market price is not reflecting NAV. Now, the net asset value of the ETF is the worth of it based on the price at the end of the day, right? But intraday, there could be movement because there's demand and supply component that kicks in due to the trading. Default or counterparty risk, I've explained. How to purchase an ETF? Okay, I'm not going to go through. I'm so sorry. Open a brokerage account, have a securities account, start trading, but do your homework before you trade. I think with that, I should end off. And I apologize to the next speaker. I apologize. Thank you very much.